Let's look more broadly now what is going on in markets, what's driving them. Tony Sycamore joining us from IG. Tony, welcome.
Thank you, Andrew.
Taking a look overnight, it's all about Nvidia.
It is. I mean, tech stocks, where does it stop? And it's just dragging US indices up. There's a lot of comments surfacing about the divergence and the relative performance of the other stocks within the S&P 500. But if you're trading an index, it doesn't really matter. You've got to be respecting what the price action is in those big stocks. And it just looks like we're in this melt-up phase, this blow-off type phase, and I don't see what actually stops that unfolding further at this point of time. In terms of the Nasdaq chart, it's the Nasdaq 100 pushing up towards that 20,000 area. There's another level above there around 21,050. And that probably is where we will start to see those extreme overbought readings start to be worn off. But all in all, I mean, this is a market which is in an uptrend. You're looking for a pullback to buy. I just don't know where it changes. Potentially it's that retail sales data last night, which was softer than expected, following very soft preliminary Michigan Consumer Sentiment Index on Friday. The US consumer is the heartbeat of the US economy, and it is slowing. They want it to slow, but they've got to be careful that they don't stop that heartbeat once and for all. So it's a real juggle for the Fed.
Well, it's that balance, isn't it? Because obviously if you've got weaker economic growth, that's going to hit earnings, yet it would also perhaps bring forward the chance of rate cuts. So yes, it is a tightrope, isn't it?
Yeah, and the problem is once you stop that heartbeat, you stop that resilience, you undermine it to a point where it just doesn't want to reinvigorate, that becomes problematic. So rate cuts are necessary, and it's a juggle, it's a narrow path. We heard the RBA say it yesterday. We're getting now towards the pointy end of where this all starts to unfold.
So what are we going to be looking at next on the US market that's going to indicate whether it's going higher or lower, do you think? What's any sort of data, or what are we looking for?
I think, when we talk about data, we're talking about interest rate expectations, and the US tech sector just hasn't really responded to what's going on in that space at all. But absolutely, we've got to continue to watch the inflation numbers. We do know that the Fed want to see another few months of cooler inflation data before they cut rates, employment data, and I keep harping back to this consumer, this US household. They are tightening their belts. They have to. Their savings rate is dipping. They're fighting cost of living pressures. Interest rates are going up. Maybe not on houses, but on things like credit cards, on car loans and things like that.
Meanwhile, Tony, no sign of any rate cuts locally, given the RBA left rates on hold yesterday and was seen to be a little more hawkish in the previous meeting. Yet, we saw the local market continue on its merry way.
I don't see there being too much in yesterday's RBA meeting that wasn't expected. They kept rates on hold. They will continue to prioritise bringing inflation back to target. It has become slower, the descent, we know that. And I think by this hawkish jawboning, they're probably hoping the need to avoid interest rate hikes. I don't think they want to hike rates at all. In fact, I think they probably would be preferred, given the way that the GDP profile is slowing, given the way retail sales here is also slowing. They do need to continue to tread this very fine line. So by jawboning this month, potentially it will alleviate the need for interest rate hikes. But we do know that if Q2 inflation on July the 31st is hotter than expected, you've probably got a live meeting on your hands in August.
All right, so how's that reflected what we're seeing on the equity market at the moment?
The equity market, well, it just didn't absolutely take a beat backwards yesterday. I mean, it started strongly following gains on Wall Street, but by and large, it's doing what we thought it would do, Andrew. It's trading within this range, and I think that continues into the end of this month. Potentially in July, early July, we'll see it push up towards the top of that range. And if we can get above 7,900 to 7,910, that's a pretty good sign that we're going to continue on higher. But for this point of time, we're in a holding period. There's concerns around China. You mentioned Fortescue had a tough day yesterday. These iron ore miners certainly aren't out of the woodworks in terms of the Chinese property sector and their exposure to the Chinese economy. That suggests to me that we've got another 2 weeks of trading sideways into the end of the financial year, and then we can start to look for some sort of exploration towards the upside there, if that makes sense.
Checking the currency, Tony. Now, if the RBA leaves rates on hold and the Fed starts cutting, albeit later in the year, obviously that interest rate differential is going to close. What's that going to do for the Aussie?
It's supportive of the Aussie dollar. The more hawkish tilt we saw yesterday from the RBA at the margin supported the Aussie dollar. It's closed up around 66.60 overnight, but it still has some issues. It's got China percolating away in the background, the deleveraging in the property sector, iron ore prices at $106. They're not at $120 anymore. And you have this important layer of technical resistance coming in around 67.20ish. So it's got up there 3 times and it's been slammed each time it's got up there. It hasn't fallen out of bed, mind you. It's still holding above the 200-day moving average. But what that's saying to us is just not ready. All the dots aren't lining up. Potentially it is the change in interest rate differentials, which you alluded to. Potentially it's iron ore starting to see some signs of recovery because they expect more stimulus in China. But at the very end of the day, the Aussie's got to get above 67.20 to open up a move potentially towards 70 cents.
Let's focus on commodities, starting with gold. Now, once again, this is very much an interest rate story at this point. In fact, overnight we saw the US dollar and those bond yields come off, and as a result, gold did move higher. What sort of support levels are you looking for there, Tony?
Yeah, the big one remains that 22.75 area. Providing it holds above there, the move that we've seen over the past couple of months looks more corrective than anything else, which suggests that it will lead to a retest of that 24.50 high. If, for whatever reason, we saw a break below 22.75-ish, then 2200 becomes the next downside target. But we do also have some support coming into gold because of the geopolitical situation in Israel. We did hear one of the cabinet ministers talking about a war with Hezbollah in Lebanon's not too far away. That's not good news. And of course, Ukraine sending more drones Russia's way. That situation continues to percolate as well.
Yeah, and that is also affecting, obviously, the oil price at the same time. Those geopolitical risks, plus signs perhaps of greater demand over the Northern Hemisphere summer. So what are we seeing with oil?
Oh, it intrigues me because we had that panic sell-off down to 72.50 or thereabouts. And then the rebound came because OPEC, who have a vested interest in saying oil's going higher, and the EIA also said, look, we're forecasting good demand. But where is that good demand coming from? Well, we just spoke about the state of the US household. We spoke about the state of the Australian household. In Europe, there's a lot of uncertainty there because of the political situation in France, although I will say that does, to me, seem like a storm in a teacup. And I sat on the desk of a French bank during the European sovereign crisis over a decade ago. We're seeing a very lightweight version of that at this point of time. But where is this demand pickup coming from? That's my question with growth slowing down. China's still in the doldrums to some extent. But when you look at that chart, it is what I call a V-shaped bottom. And when you see a V-shaped bottom, a market selling off and then bouncing out of there very, very quickly, that probably signifies that you've got the basis for a low in place there. If it can get above $81 now, then potentially we can head back up towards $85, potentially $87.
And a quick check of Bitcoin, taking a bit of a tumble just recently.
Yeah, it's really testing my patience, actually, Andrew, because I have been bullish. And look, it got up to 72,000 a number of times. It's had sellers up there despite these Bitcoin ETF flows, despite the risk backdrop being very supportive for risk assets such as Bitcoin. It started to fall away, and where it is now currently is it's testing that uptrend support from the 38,500 low from earlier this year. That's coming in around 64,000 to 65,000. So providing it holds above here, then you can look for a push back up towards those high 74,000 area. Falls below there on a sustained basis over the next 24 to 48 hours, I think you're probably going to rotate back down towards that 56,500 low we saw a couple of months ago.